Well, guys and girls, it is that time of the week, the market wrap, and if you follow me, you know that this is not a normal weekend for me because I'm away, and I am letting you know that I still thought to myself, I'll give you a little bit of commentary about this marketplace based on the rate rise and other things that have been spoken about in the last couple of days from both the Reserve Bank and the Commonwealth Bank. So let's kick off with the Commonwealth Bank. They have now confirmed there is a 50% chance Australia is going into a recession. Matty Carpenter, good to see you. Brad, good to see you. By the way, I've ducked myself away in a cafe in Ubud, quietly shooting this video. Good to see you all. So Commonwealth Bank now has confirmed there's a 50% chance of a recession. And even the Reserve Bank now's dialogue and language is saying the hard landing that they were trying to avoid may be unlikely. So the tone has changed, right? The tone has changed because now they're actually sort of suggesting that there's more rate rises to come. They're looking at the numbers, but I just want to give you an idea of what the impact of these rate rises are. Get ready for this. If we have one more rate rise, which we will be having, we're going to see a simple $500,000 loan. You know, and we're talking about $500,000 loan. Most people have got loans a lot more than $500,000. That a $500,000 loan, and I'm using $500,000 because we're talking about the low socioeconomic people, the most vulnerable cohort of people. They are the ones that are being impacted, not people that have paid their homes off, right? So let's have a quick look. $500,000, your loan repayments will be $3,701 a month. They have gone up $1,366. They've gone up by $1,366 since May last year. So your loan repayments would be $3,701. Let's actually look at. Let's actually have a look at. Oops, I'll open this up. Let's actually have a look at of what it would mean on $1 million loan. On $1 million loan, which is more like it, on $1 million loan, the loan repayments are going to be $7,400 a month. I mean, I was on with Mark Burris the other day. We have never ever had people's loan repayments being such a big proportion of their incomes. You can turn around and you can say, hey, listen here, yeah, but there was interest rates were 18%, you know, in 1991, 1992, they're only, you know, whatever, 5.5%, 6%. But don't look at that. Look at people's income proportional to their actual loan repayments, right? So I've got to tell you, there is a big group of people that are very vulnerable. So what actually happens to the people, you know, come September, right, when all these things have kicked in, they've gone from their fixed to their variable rates, which we all know now the data, that they're all happening between July and March next year. These are all the people that are going off fixed to variables, right? What's going to happen to these people? Think about that, work it out. They've got three options. Option number one, they go to Relos and they ask for money to help out short term. And that's already happened. I've already had friends of mine ask me whether they should lend money to people they know. They just, you know, as a sounding board, you know, they want 30 grand here, should I give it to them? That's the first thing. As Brad's seeing it, he's already seeing people selling investment properties. The second option that they might have is that they're going to turn around and what they'll do is they'll go off and refinance. How can you refinance? Think about it. What are you going to refinance now that your rating has actually gone down? Because we know that people's borrowing capacity has dropped 25%. So that's not really an option. Then you look at the third option. And what is it? You sell. And that's when you start seeing problems happening because you start seeing distressed sellers devalue the rest of the market. And Shane Beaumont is saying here we are seeing so many of these eastern suburb state investors cash out of investment properties, even though that they are doing so well as their own home is actually one that's stretching them. Good point, Shane. Good point. So, team, what does it mean also? Let me have a look here. What does it mean also to someone on a $750,000 loan? Next rate rise, your loan repayments are going to be 5,551, right? 5,551. Mate, listen, you know what people get paid? After they pay tax and they've got to pay their mortgage repayment, man, I've got to tell you, their lifestyles are going to be impacted 100%. So, team, I agree with what Mark Burris says, and that is if you're an owner of property and you can actually smell that there are problems coming your way, you are far better selling before the problems happen, right? Where you take control of your position, right? You take control of your position. That's what I would be doing. And I'd also be doing it for another reason. I'd be doing it because you don't want to be in the mix when it gets really rocky and bumpy and the waves are hitting people's faces and you've got a bunch of people that are selling at the same time. And that's happening. CoreLogic RP data are very clear. CMAs are happening through the roof. There is a high level of people getting appraisals, and that is the beginning. An appraisal is the beginning of someone putting their property on the market. Anyway, team, I want to say thank you again. Yes, low auction volume day. I mean, there's a lot less auctions in Sydney. That's why I actually took this week off. And, my final words to everyone here is stay well, stay healthy. Thank you so much for your birthday wishes, and signing off.